COVID-19, as much pain and disruption it has brought to our daily lives, has also become an unexpected catalyst for the digital economy. Join us as we discuss the pandemic's long-term impact on the industry and the companies you should pay attention to in 2021. Our next speaker is Mr. Tan De-jun, Senior Equity Analyst, Stocks and ETFs Research, iFAST Singapore. De-jun is an equity analyst with the research team at iFAST, providing analysis and research coverage on both stocks and ETFs listed on the Singapore, Hong Kong, and the US markets. The global technology and semiconductor sectors are De-jun's areas of expertise. De-jun has also contributed his views to the local media, including Business Times, Lianhe Zaobao, and 96.3 FM. De-jun, please.
Good afternoon, everyone, and welcome again to What and Where to Invest 2021. My name is De-jun, and I'm an equity analyst at FSM1. And for this segment, I'll be sharing with you about the digital economy, how COVID-19 has affected it, and more importantly, the investment opportunities that we see over the next couple of years. So without further ado, let's begin. So the world as we know it is on the cusp of a new technological revolution known as the Fourth Industrial Revolution. So this marks a turning point in human history where the widespread use of digital technology such as the internet is blurring the lines between the physical and the digital world, changing the way we live, work, and interact with each other. So unlike the previous three industrial revolutions, digital technologies today are evolving at such breakneck speeds that individuals and businesses are finding it hard to keep up with the changes at times. And those who fall behind run the risk of being rendered obsolete. So the rapid digital transformations happening across all industries and sectors will bring about many new investment opportunities, especially among the companies that are able to adapt to the changes quickly. And as the world we live in becomes increasingly digitalized, the digital economy will likely become an integral part of every investor's portfolio. So what exactly is the digital economy? So the digital economy can be defined as a massive web of interconnected shareholders and supply chains covering all digital products and services that are enabled by the internet and other digital technologies. So while there is a lack of an industry classification system due to its complex nature, the digital economy can be broadly categorized into the following 8 segments. So let's talk about some of them. So e-commerce, for instance, is a segment that I believe most of us are already familiar with. Here, e-commerce has fundamentally transformed the way people shop for physical goods, with online retailers such as Amazon and Alibaba having an outsized impact on the broader retail market. And as more people choose to shop online, brick and mortar retailers are forced to reinvent themselves for the digital era. So cloud services is another fast-growing segment within the digital economy. So here, cloud service providers provide the hardware and software components that are needed to support the data storage, computing, and networking requirements of a business. So as companies migrate a greater portion of their workloads onto the cloud computing industry is set to see explosive growth ahead. So lastly, let's talk a bit about digital advertising. So because consumers are spending more and more time on the internet compared to traditional media, engaging with them is not the same as before. So for firms who are looking to advertise themselves, digital advertising is almost always a necessity in order to maintain a strong online presence. So collectively, these 8 segments of the digital economy make up roughly $9.5 trillion US dollars. That is roughly 10% of the world's GDP. So if you were to think of the digital economy as a national economy, it would be actually the 3rd largest in the world, behind only US and China. So taking a look at the changes in the world's largest companies across time gives us a sense of how quickly the digital economy has developed over the years. So compared to a decade ago when only 2 of the top 5 companies are considered digital economy stocks, every single one of the top 5 largest companies today belong to the digital economy. Looking ahead, we think that the digital economy still has plenty of room for further growth despite the disruption caused by COVID-19. So on the topic of COVID-19, I think it is safe to say that the pandemic has caused a lot of stress on our lives, but at the same time, it has also revealed the importance of digital readiness. So during this period, companies that have performed well are generally those with an established online presence, while those that perform not too well typically do not. So a case in point is the retail industry, where we have witnessed several brick and mortar retailers such as JCPenney's file for bankruptcy. But at the same time, e-commerce firms such as the likes of Alibaba and Amazon have continued to report record profits over the same period. So COVID-19, we think that it has had a disproportionate impact on the various sectors of the global economy, with some more badly affected than others. But in the case of the digital economy, we think that COVID-19 is actually an unexpected catalyst, one that will produce a net positive impact in the long run. So we say so because we believe that after this, many companies will likely accelerate the adoption of digital technology, and that is not just to prepare for the next crisis, but also to remain competitive in a digitalized world. So as a matter of fact, we are already experiencing the positive impact of the pandemic on the digital economy, as the share price of OGIG, which is our recommended ETF for exposure to this sector, has actually more than doubled in 2020. So this is in stark contrast to the performance of broader equity markets such as the STI or even the S&P 500 index, which delivered gains of only 15% in 2020. So with that being said, investors who have held on to this ETF for the better part of 2020 would have likely made decent returns already and may want to consider taking some profits off the table. However, we caution against selling out completely. So the reason for this is when it comes to portfolio construction, asset allocation should always reflect economic reality. And the reality is that going forward, internet companies will make up a larger part of the global economy and the financial markets as well, as the world we live in becomes increasingly digitalized. So this is also the fundamental reason for why we have decided to include OGIG as a core component in our discretionary portfolios. So looking forward, even though valuations might seem a little stretched at this point in time, we note that the long-term outlook for the digital economy remains robust, as the industry is expected to deliver strong earnings growth supported by megatrends such as rising internet adoption rates and the widespread digital disruption. So despite expanding at an exponential pace in the recent years, global internet usage remains far from saturated. So the number of internet users worldwide currently represents about 60% of the global population. That also means that there is still a large number of people who do not have access to the internet. So across the world, there are vast differences in the maturity and the extent of internet services available in each region. So developed regions such as North America and Europe, for example, are nearing saturation with penetration rates as high as 95%. The penetration rate in Asia, on the other hand, remains relatively low compared to developed markets. And this is despite the fact that Asian economies have a combined population of exceeding 4 billion people, accounting for more than half the global population. As internet penetration rates in Asia converges with developed markets, the digital economy is likely to see promising growth over the next few years, and with internet companies being the main beneficiaries. So besides the rising internet adoption rates, another mega trend that will contribute to the growth of the digital economy is the widespread digital disruption. So digital disruption is a transformation that is caused by emerging digital technologies and business models. And this in turn is caused by a structural shift in consumer habits, such as the shift from offline to online. So as more people begin to spend time online, digitalization has become a necessity for businesses that wish to remain competitive in this new global backdrop. To stay ahead of the competition, companies across all industries and sectors have been adopting digital solutions as an alternative source of revenue and as a way to improve efficiency. So e-commerce is a good example of this. So compared to the past, many brick and mortar stores today are turning towards e-commerce, which vastly broadens their reach. So in 2019, worldwide e-commerce sales hit a record high of 3.5 trillion US dollars. So the majority of which came from China, which is currently the largest e-commerce market in the world. So over in China, players like Alibaba, Jingdong, and Pinduoduo control roughly 80% of the e-commerce market. So if you look over to the West, the US is actually the second largest e-commerce market. There, Amazon has a market share of roughly 50%. So the global e-commerce market is estimated to grow at a compound annual growth rate of about 16% over the next 3 years to reach a value of 6.5 trillion US dollars by 2023. So all in all, we think that as these megatrends begin to unfold, demand for digital products and services will continue to rise, and so will the earnings and share prices of these companies. So after all, earnings are the key driver of share prices in the long run. So investors who do not have exposure to the digital economy but are keen to invest at this point in time, you may want to consider using a regular savings plan. And the reason is because using a RSP will ensure that you buy more units when prices are low and less unit when prices are high, bringing your weighted average cost down. And in the future, when the opportunity presents itself, you can also always switch from an RSP to a lump sum investment then. So within the broader digital economy, one segment that we have our eye on is China. So China has come a long way since the 1980s, growing by leaps and bounds to become a global economic powerhouse. So today, it is the second largest economy in the world with an approximate share of 15% in global GDP. So part of the reason for China's rapid growth is its widespread use of technology. So for the majority of Chinese citizens, technology has now become an indispensable part of their lives, one that is hard to live without. So the importance of technology is also reflected in the financial markets as the tech companies make up some of the largest companies in China today. So compared to 10 years ago, if you can see from the chart, most of the largest companies actually come from the oil and gas as well as the financials industry. But despite the rapid growth of China's tech sector, we still think that China's tech sector is relatively young and there is still plenty of opportunities for tech companies to play a bigger role as the economy becomes increasingly modern. So similar to the rest of the world, a key factor that has contributed to the rapid growth of China's tech sector is the increasingly digitalized consumption habits of its people. So not only is consumption growing, consumption habits have also become increasingly digitalized where consumers are more willing to pay for the convenience of on-demand services such as food delivery, ride-hailing, to even more complicated things such as travel booking and online banking. These days, almost everything can be done online thanks to advancements in technology. And as consumption habits change, there are plenty of opportunities within China's tech sector. So earlier, I mentioned that China is actually home to the largest e-commerce market in the world. And this is because e-commerce is becoming the new model of retail in China, with the percentage of retail sales conducted online increasing steadily over the past few years. And as of 2019, roughly 20% of the total retail purchases in China is done online. And that number is actually expected to increase over the next few years as the country becomes increasingly digitalized. So besides the greater use of technology, there are a couple of reasons why the online consumer market in China is booming. So first of all, with greater economic progress, wages are rising, and the Chinese population is getting wealthier than ever. And when I say that, I don't just mean for the people who live in the cities, but also for the people who live in the rural regions as well. So disposable income for both groups are at an all-time high, which leaves people with more money to spend. Second, China has a huge number of internet users. So even though its internet penetration rate of 61% pales in comparison to developed markets, China already has 850 million internet users. And that number is actually greater than the total population of every other country in the world, with the exception of India. And with penetration rates on an uptrend, internet companies will stand to benefit as online consumption rise. So here's a graphic for you to visualize just how large China's internet space is. So as you can see from the various segments, even though China has a lower penetration rate, the number of internet users still far outweighs the US. And the only segment where China has a higher penetration rate than the US is actually in mobile payments. And this is because China essentially skipped the entire credit card era, moving straight from cash to mobile payments. So these days, mobile payments, they are a widely accepted mode of payment for most merchants, from restaurants to even street hawkers. So if you're planning a trip to China when travel resumes, make sure that you familiarize yourself with how these apps work before you go. So earlier, I mentioned that the number of internet users in China will rise over the coming years. And these are expected to come from two distinct sources, which are your millennials and the rural population. So let's talk about millennials first. So for Chinese millennials, it is estimated that there are roughly 350 million of them. And millennials, many of them, they are brought up in an era where they're constantly exposed to technology and have grown to become avid internet users. So in fact, millennials actually contributed to 2/3 of the total online consumption growth last year. And with their higher spending power and greater propensity to spend, millennials are progressively becoming China's biggest source of online consumers. Next, China's rural population of 560 million people is another huge untapped market for internet companies. So penetration rates of only 40% in the rural regions still remains well below urban regions' penetration rate of roughly 60 to 70%. However, this is quickly changing as the government has been pushing big telco players to speed up the construction of internet infrastructure so that the rural population does not get left behind. So the rising number of internet users from the rural regions will present Chinese tech companies with new growth opportunities. And in fact, many internet companies like Meituan, for example, have reported that growth in the recent years is largely driven by the rural regions. So all in all, we think that China's technology sector is still in a nascent stage and it still has plenty of opportunities for investors as the country becomes increasingly modern. So now that you have a better understanding of China's tech sector, let me introduce to you our recommended ETF, which is the iShares Hang Seng Tech ETF. So this is a new ETF which was only listed on the Hong Kong Exchange back in September last year. And the objective of this ETF is to track the performance of the 30 largest technology companies listed on the Hong Kong Exchange that have high exposure to tech themes such as the internet, cloud computing, and e-commerce. And to be included in this index, companies must fulfill certain requirements such as having minimum turnover, revenue growth, as well as R&D expense. However, do note that for this ETF, unlike OGIG, this ETF does not purely invest in internet companies as it also contains a number of hardware companies such as Sunny Optical and SMIC. So other notable holdings for this ETF will include many of the Chinese internet giants like your Meituan, Alibaba, and Tencent. So besides the exposure that it gives, another reason why we have chosen this ETF is because it ranks well compared to its peers based on our own in-house ETF selection methodology, where we analyze a variety of factors such as your expense ratio, tracking difference, and liquidity. And we like this ETF because it has one of the lowest expense ratios among its peers, making it the perfect instrument for cost-conscious investors. And as we already know, high expense ratios, they are not very desirable because if they are compounded over a few years, they can be a significant drag on returns, which is why we tend to favor ETFs with lower expense ratios. So overall, we think that this ETF is actually one of the best in the market for investors who are seeking exposure to China's rapidly growing tech sector. So in conclusion, given the structural megatrends behind the digital economy, we believe that internet companies will be able to deliver superior earnings growth over the next few years, which is a key ingredient that will drive share prices higher. And investors who are seeking exposure to the global digital economy may want to consider the iShares Global Internet Giants ETF. Alternatively, those with a preference for China can consider the iShares Hang Seng Tech ETF. So with that, I've reached the end of my presentation today. I hope that through this session, you have been able to gain a better understanding of the digital economy, its prospects, and most importantly, why we are so positive on this sector. Once again, my name is Te Chun. Thank you all for being here today, and I wish you all the best in your investing journey.